bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the November 28th, 2023 podcast. I do hope you had a wonderful Thanksgiving. And let me start this week's podcast by also saying thank you to everyone who joined us earlier this month at the Novogradac 2023 Fall Renewable Energy and Environmental Tax Credits Conference. I want to give a thanks to both those who attended in person in Washington, D.C., as well as all virtual attendees. The conference was a sold-out event, and I was happy to see as many as were able to join us. I also want to note that our next in-person renewable energy event will be May 16th, 2024 to May 17th, 2024 in San Diego. And I do encourage everyone to register early for that event since Washington, D.C. did end up selling out. Now, the subject of today's podcast did come out of our D.C. conference, as the topic was a recurring theme across many panel discussions and in private conversations. And that is, how has recent legislative and market changes influenced which ownership structures that renewable energy investors and developer sponsors are selecting to best apportion the variety of economic benefits that are generated from renewable energy facilities? Now, to start to unpack this question, let me list out the four major economic benefits that are generated by renewable energy facilities. And they are tax credits, tax losses, annual cash flow or operating cash flow, as well as residual or exit cash flow. Those are the four: tax credits, tax losses, operating or annual cash flow, and residual or exit cash flow. Now, I should also note, so I will, state tax credits may also be available, but rarely. And there may also be renewable energy state rebates. But these state rebates are received as cash by the owner of the renewable energy facility and reported as taxable income. So in some ways, it's similar to operating cash flow revenue. And there can be other economic benefits, but we're going to focus on these four in the podcast today. Now, investors and sponsor developers have a variety of ownership or entity structures that they can use to facilitate sharing these economic benefits. And the enactment of the Inflation Reduction Act has altered the relative attractiveness of the various structures. Now, the most notable provision, at least in my opinion, in the Inflation Reduction Act as it affects entity structuring choices is the ability of a taxpayer to transfer renewable energy tax credits. Now, upon enactment of the Inflation Reduction Act, much consideration was given to the impact of this transferability provision, but investors and developer sponsors needed guidance from the IRS and Treasury before they could move forward with confidence. Fast forward to last June, and the IRS and Treasury released rules that govern and facilitate the transfer of renewable energy tax credits, which means we're just now seeing investors and developer sponsors adopting ownership structures where the equity investor receives tax losses, cash flow, but no tax credits. Now, my guest today is my partner, Tony Grappone. He's here to discuss in more detail these various benefits that investors can receive from investing in renewable energy transactions, as well as which ownership structures he's seeing gaining in popularity. I'll also note that Tony and I co-wrote an article for the Novogradac Journal of Tax Credits this month on this exact subject. I will include a link to the article in today's show notes. We do have a lot of insights to share with you, so if you're ready, let's get started. Tony, welcome back to Tax Credit Tuesday. It's our third installment in the Renewable Energy Tax Credit Finance series.
Great. Thanks, Mike. I'm glad to be back.
Now, most of our listeners, Tony, know who you are, but for those that don't, if you could briefly introduce yourself, I'd appreciate it.
Sure. Thanks, Mike. So I'm a partner with Novogradac Company. I'm based in the Northeast. I oversee a variety of different services for the firm, ranging from transaction advisory related services, which take the form of financial models and related consulting. Also oversee a team that specializes in auditing financial statements, and then another team that specializes in preparing tax returns. I spend most of my time working in the renewable energy industry, but I also still service clients in the affordable housing industry, new market tax credits, as well as the historic tax credit industry.
Great. Thank you for that, Tony. And I'll also include Tony's email address in today's show notes so you can reach out to him. So Tony, in my introduction, I listed 4 central economic benefits that are generated by a renewable energy tax credit facility. And I thought before we move into the types of ownership structures, it'd be first worthwhile to dig down a little bit deeper in each of these benefits. So starting with the first, and that is the tax credits, share a little bit more about types of tax credits that are generated by these facilities.
Great. Thanks, Mike. So in terms of tax credits, renewable energy industry facilities can either qualify for investment tax credits or ITCs, or some other technologies qualify for production tax credits or PTCs. In ITC facilities, well, let me just take a step back here for and say tax credits are a dollar for dollar reduction in your tax liability. And in a moment, we'll talk about tax loss benefits, and I'll talk about how loss benefits are different from tax credit benefits. So tax credits, again, they reduce your tax liability dollar for dollar. Investment tax credits are based off of qualified construction costs, usually a percentage of your qualified construction costs. Whereas production tax credits are based on the amount of clean energy that the facility produces and sells to a third party. Okay. Investment tax credits are generated in the year that the facility is placed in service, meaning commences operations. Production tax credits are generated over a 10-year period starting in the year the facility is placed in service. Okay. And then one last note, and I'll kind of echo this again when we talk about tax loss benefits, but one other note I'll make about PTCs versus ITCs. PTCs aren't subject to what is referred to as an ITC basis reduction. And what that basically means is for PTC property or production tax credit property, you can depreciate more of your facility cost. With ITC property, there's a requirement that that the taxpayer reduce the depreciable basis of its property by half of the ITC. So you get fewer depreciation deductions on ITC property.
Great. Thank you for that, Tony. And I would just note that for many types of properties, the sponsor developer gets to decide which of the two to claim. That's accurate, is it not, Tony?
They certainly have their preferences. Okay. And at the end of the day, the structure or the tax credit they will ultimately claim will be dictated in part by what investor options are available in the marketplace and the structures that they prefer.
And that's something that as a listener, you can reach out to Tony if you're looking at a particular facility and trying to decide which path to go down. Tony can help with that decision process as part of his transaction advisory services.
Exactly.
So you mentioned tax losses. So if you could share a little bit more about what's generating the tax losses, over what period of time they're generated, and the like.
Excellent. Sure. So for renewable energy facilities, they generate, well, when we say tax losses, really what we're talking about there are tax depreciation benefits. And so I think that's important just to clarify because these facilities, they typically they operate profitably. So their EBITDA or the net operating income is positive. What creates the tax loss? What creates the tax loss is almost always depreciation deductions. The IRS allows taxpayers to depreciate renewable energy facilities over an accelerated time period. Most of the property qualifies for what's called 5-year makers depreciation. And so that's an accelerated timeline to depreciate these facilities that really have an estimated economic useful life of far longer than that. But in an effort to further encourage taxpayers to participate in the industry, the IRS allows taxpayers to take those deductions over an accelerated timeline. Even more so, the 5-year makers property can also qualify for what's called bonus depreciation. And bonus depreciation currently allows a taxpayer to expense up to 80% of its depreciable property in the year the facility is placed in service. And then the balance, the portion that wasn't claimed through bonus depreciation, is then depreciated over 5 years. If for some reason you don't want it, if it's problematic to depreciate your facility over such an accelerated timeline, taxpayers can also choose to slow down depreciation a bit. And sometimes that's actually an important consideration as part of the overall tax structuring. And so if you actually prefer for tax structuring purposes to slow down your depreciation, there is an opportunity to sort of delay the deductions over a longer timeline. But generally speaking, you're talking either 5 years or on a super accelerated basis using bonus depreciation.
Maybe say something about the basis adjustment.
Great. Thank you. Right. Again, sort of when you think of ITC property, if you're claiming the ITC, the IRS requires that you reduce your depreciable basis by half of the ITC. And so if the tax credit is, if you built the plant for $1 million and the ITC percentage is 30%, so your ITC is, call it $300,000, half of the tax credit in this case is $150,000. And therefore when in terms of figuring out your depreciable basis, you'd start with your $1 million of cost minus half the ITC of $150,000, and then you'd get to adjusted depreciable basis of $850,000. And that's what you would depreciate for ITC property. For PTC property, you don't have that same ITC basis reduction requirement. So as a result, you start with your $1 million and depreciate that entirely. Now, to make things even more interesting, if you were to pivot for a moment, and I know we'll talk about structures more in a moment here, but if you were to pivot and use a structure that's referred to as the inverted lease structure, and the inverted lease structure, that even if if you're claiming the ITC, but using the inverted lease structure, you don't have to apply the ITC basis reduction. You get to report the full $1 million worth of depreciation, even though you're using the ITC. However, the sort of catch-all that the IRS requires taxpayers to sort of make them whole on here is the IRS requires the parties that claim the tax credit to recognize into income the equivalent amount of what that ITC basis reduction would have been. And that is commonly referred to in the industry as what we call 50D income. So,
Yep. Thank you for that.
so you can tell it can get confusing quickly. It's complex stuff.
Yeah, in case you're listening and wondering why it's called 50D income, that's the code section that generates the statutory requirement that this income be recognized. And it's almost sort of like anti-depreciation expense or contra depreciation expense. That's what the 50D income is. I just would also note that the expensing, that the bonus depreciation, which I always and that's what it's called in terms of the Congress and the rest, but I always think of bonus as extra. And it's really not bonus depreciation. It's really expensing of the asset. And Tony mentioned you can expense 80% of the asset, and that it was 100%. It's now 80, and it's phasing down 20% a year. So when you're running models and the rest, you need to be looking at when you place the property service and the like and transition rules to identify what your what your actual expensing amount is. And I'll also note further that there is a legislative effort at the end of this year, going into early next year, to extend bonus depreciation or expensing and go back to 100%. So if you're working on a transaction, you should be bearing in mind that the tax law could change, and that change could apply to your development. And you want to make sure to be discussing that with your investor.
Hey, Mike, while
Yes.
we're still on the topic of tax depreciation, I forgot to mention, the value of the depreciation deduction is the deduction multiplied by your effective tax rate. And so earlier, I mentioned how tax credits are equal to, it's basically a dollar per dollar reduction in your liability. With depreciation deductions, it's the amount of the deduction multiplied by your effective tax rate. So if you had $1 million of depreciation deductions and you're in, say, the corporate tax rate of 21%, then the actual benefit from that deduction is $210,000.
Yes.
So
And to further complicate matters, we'll keep it at that. We'll only talk about federal income taxes. And the question could become what the potential state income tax benefits can be and what the state rules are and the rest, but we'll save that for another day. So let's move on to the third of the four benefits. We talked about tax credits, which are dollar for dollar. Talk about tax losses, which are a value based upon the effective tax rate of the investor or the owner. The third is operating cash flow. So if you could share a bit about operating cash flow with a mindset towards some of the differences between what is commonly investment tax credit property versus what is commonly production tax credit property.
great. Yes, indeed. So this is a area of significant concern for the developers. See, the developers are trying, they obviously want to preserve as much of the cash flow benefits as possible for themselves. Okay. So the project, generates net operating income. So you've got sales of electricity minus your core operating expenses, which again are like taxes, insurance, O&M, site lease expense, and G&A, general administrative expenses. So sales minus those OpEx gets you to net operating income or EBITDA. That's a positive number. Now a developer is wondering how much of that cash flow do I need to share with a tax equity investor? And the developer is obviously trying to minimize that number. Okay. Meanwhile, most tax equity investors in the renewable energy industry are what I like to think of as pure play tax equity investors, meaning they're really primarily motivated to invest in the credits and the depreciation benefits. However, for certain tax structuring reasons, they may need a certain amount of cash flow from their investment to satisfy certain tax tests, okay? Or just to maintain a minimum yield requirement, okay? And so there's a lot of careful financial modeling that goes into this analysis to help the developer figure out what that minimum amount of cash flow is necessary to meet the investor's requirements in order to maximize the cash flow they themselves can keep. A very popular structuring mechanism used here around the cash flow benefits is where the investor will require what's called a priority return of cash flow or a preferred distribution, sometimes referred to as. And the way that is determined is it's essentially you take the amount of capital that the tax equity partner has invested into the partnership and you multiply that by some preferred return percentage. And a pretty typical preferred return range is sort of 2 to 3% of their invested capital. And so every year the investor will get back in the form of priority return cash flow somewhere between 2 to 3%. I mean, it can be different than that, but most common what you see in the marketplace is say 2 to 3% of their invested capital will go back to the investor in the form of a preferred return. And that oftentimes that'll make up the majority of the cash flow that the investor gets back. They can and often do get some variable cash flow on top of that, but to minimize that, the parties will oftentimes rely on certain IRS tax guidance support to help protect the amount of cash flow that goes to the investors and therefore stay with the sponsor. Did that make sense?
Yes, that makes perfect sense. So we
Great.
have the tax credits, we have the tax losses, or really the tax savings and the tax losses as the benefits. Then we also have the operating cash flow can be shared between the owner and the investor. And then lastly, when the investor leaves, there'll be some cash available to them on their exit and or when the facility is disposed of or refinanced, there could be cash flow. So the operating cash flow is what I'll call programmatic cash flow. This other cash flow is the episodic cash flow. And if you could discuss a little bit about that in the context of sharing between the investor and the sponsor developer.
Sure. And while I describe that, I'll kind of allude to some of the structures. You and I did a podcast recently where we talked about the various structures used in renewable energy. And so depending on which structure you use can really impact the amount of cash that the investor gets upon leaving the investment. Okay. Most, again, pure play tax equity investors have a goal of trying to get out of the transaction once the tax credits are, I'll call it vested. So they've fully earned all the tax credits. And so for investment tax credit transactions, that would be at the end of the 5-year ITC recapture period. And then obviously with production tax credit property it would be at following the end of the 10-year PTC period. Okay. Now let's imagine that it's an ITC investment and the parties used a sale leaseback transaction. Okay. In the sale leaseback structure at the end of the 5-year ITC recapture period, if the developer wants to buy out the investor from the ownership, the developer has to buy the investor out for 100% of their ownership fair market value. Okay. So that can be costly. If you pivot, then you look at some of the flip structures. Usually the tax equity investor will have a flip mechanism in place where the investor's ownership interest will automatically or pursuant to a yield criteria flip down to an ownership percentage as low as, call it 5%. And then the sponsor has the option to buy out the investor for a much lower value. Okay. Now, if the investor stays in the transaction for the full useful life of the facility, then obviously there may be some residual value at the very end of the partnership that they could potentially get. Big picture, Mike, the investor, the way these deals are structured with especially with partnership arrangements involving flips, the investor is usually budgeting on getting an exit payment equal to around 5 to 7% of the amount of capital they put in. That being said, there are, usually they're bought out for whatever their fair market value interest is. That and it will be determined either based on fair market value rights pursuant to a call option or some type of put arrangement. But the parties more or less try to budget that amount to be somewhere in the 5 to 7% of the investors paid in capital.
Great. Thank you for that, Tony. Before we move on to investment structures, are there any other economic benefits that you wanted to mention?
Yeah, sure. So some tax equity investors also like to invest in the renewable energy certificates or RECs, the green attributes that the facilities generate. So that's another popular economic benefit that tax equity investors sometimes take an interest in.
Great. Thank you for that. And I would also note we recently did a podcast with Peter Lawrence, our head of government relations, and we did talk about the Community Reinvestment Act final regulations. And some of these facilities or do end up serving low and moderate income families such that they can be eligible for Community Reinvestment Act credit. Now, that's not a tax credit. It's part of the ways in which banks are rated by the federal rating or the federal agencies that govern banks. So that could be another sort of indirect economic benefit. And there are others, but let's move on to the focus of today's podcast. And as I noted in the introduction, a common theme at our conference in DC was what types of investment structures are gaining in popularity as a result of the enactment of the Inflation Reduction Act. And I wanted you just to share what you're seeing, Tony, on that front.
Sure. So, the partnership flip structure was always the most common structure you saw in the marketplace, but it's becoming even more popular now. And that's because of the transferability option. And so previously, before transferability was an option, some taxpayers liked the sale leaseback structure because there was this 90-day rule where the investor could come into the transaction up to 90 days following placement in service. Okay. So that added some popularity to the sale leaseback structure. But now with transferability, you could use a partnership flip structure. And if you're going to sell a credit, you can sell your credit off to an investor post placement in service. And so because of that, it's taken some of the shine off the sale leaseback structure and added more sort of popularity to the flip structure. Another reason the partnership flip has become more popular is because with the inverted lease structure, you actually can't transfer or sell the tax credit if you use the inverted lease structure. Okay. And having that transferability option has proven to be extremely important to investors in the marketplace. Because of that, so now with the regular partnership flip, you can find your investor post placement in service if your goal is to transfer the credit. And you can't transfer the credit with the inverted lease. And for these types of reasons, some investors that used to favor sale leasebacks because of the whole you had to be the investor, you could be an investor post placement in service. Some of that popularity leaves the sale leaseback, adds emphasis to the flip. And because of the inverted lease, you cannot transfer the tax credit using the inverted lease. Again, piles more popularity onto the partnership flip.
Well, maybe you could expand on the use of the partnership flip structure if the investor is planning on claiming the credit themselves. And you said it creates the optionality to transfer the credit should the investor decide sometime down the road that they don't want to claim the credit. They'd rather have the partnership sell the credit. Can
Right.
you explain why investors are interested in that optionality?
So probably from a planning standpoint, you never know if you're going to be able to use the credit. There's always some general uncertainty with respect to the economy and being able to predict your tax liability perfectly. And so just having that peace of mind of knowing that if your tax liability doesn't pan out the way you're budgeting, having that option to sell the credit just gives you a lot of peace of mind, I think, internally with your investment committee. And so the structure that's really gaining in popularity is commonly referred to as the T flip. The T flip. Okay. That's
Okay.
all people were talking about that nonstop at our renewable energy conference earlier this month. And it's basically it's a partnership flip that has a transfer option. And so under that structure, you have a typical class A tax equity investor partner the way you normally would, and that partner still contributes equity to the partnership using similar terms and conditions that they've always had. Okay. But where the parties recognize that at some point the class A member may elect for the partnership to transfer the credits as opposed to keep them. And they may elect to sell some, all, they may retain some, they may sell all, they may sell just a portion. But that T flip structure is what is referred to in the marketplace is definitely picking up steam as the go-to structure.
And maybe you could, this is a bit off course, but some listeners might be thinking if the partnership were to sell the credit, if it was a state tax credit and you sold it, the partnership would have income, taxable income, which would be obviously be subject to tax. What happens? And obviously I know the answer, but I'll let you share the answer. What happens if a partnership sells a federal renewable energy tax credit?
Great. Yep. So yeah, you pointed out with state tax credit sales, those sales transactions are taxable, but with federal renewable energy tax credit sales, that's the proceeds are tax exempt. It's tax exempt income. And so, and wait, there's more. And so the other thing is when you have tax exempt income, that income gets allocated to the partners in the partnership. And when you receive an allocation of tax exempt income, it increases your basis in the partnership which you can use for claiming more losses. So it's a real benefit.
Yes, it is a real benefit. As you say, it gives you more basis to claim losses, but also reduces the amount of the losses that are subject to recapture or gain at the end of the investment term. So, Tony, one of the essential services you provide as part of your transaction advisory practice is helping clients with financial projections or forecasts. And you and I know, and many of our listeners know, how financial projections and forecasts are so central to structuring real estate tax credit investments, really any tax credit investment. Maybe you could share the importance of financial forecasts in structuring tax credit financings.
Yeah, definitely. So, well, right away, if you're a developer, you kind of need to know what your benefit stream or your return looks like under the various different structures. And so you're going to want to evaluate the sale leaseback, the flip, and the inverted lease structure just to figure out if you have all tax equity investor options available to you, you kind of need to know how each one impacts your return. Okay. And then once you're the developer and you know which structure you want to use, and you say you get a term sheet, let's imagine you're going to use the T flip, and now the underwriting process commences. Well, there are multiple parties in the due diligence underwriting process, and they all are trying to review the underlying economics and tax benefits of the transaction. And so you've got all these parties are looking for a financial model. And so naturally, they want an independent third party or to run the model. And so they look to firms like ours because we have such a specialty practice area in the renewable energy space, especially with structuring deals. And so all these parties are looking at the model throughout the underwriting process. Tax attorneys too. Most tax equity investors require a tax opinion from a national law firm that renders those types of opinions. And the tax attorneys that render those opinions oftentimes look to us to provide a financial model to help them do their tax analysis. And there are several schedules in our model that are prepared specifically to assist tax attorneys with analyzing the partnership merits to support their tax opinion. Obviously, the investors need it to evaluate their returns. Lenders oftentimes look at our financial model to assist them with debt underwriting exercises. Okay. And then, of course, the sponsor.
So, preparing for the podcast, you and I talked about how when investors are evaluating a renewable energy tax credit investment, they can't evaluate it in as straightforward a way as looking at just the internal rate of return. And the internal rate of return is a commonly used metric in evaluating low-closing tax credit investments, where you have a 10-year stream of tax credits. Oftentimes, you're projecting a 15-year period of time wherein the investor is in the transaction. But IRR can be misleading in renewable energy investment tax credit transactions. So if you could explain to our listeners maybe why it can be misleading, and more importantly, what are some of the alternative methods that investors use in evaluating a renewable energy investment?
Sure. A lot of analysts start off by trying to run an IRR analysis on these transactions. But, especially if you're talking like an ITC transaction where the tax credit, 100% of the tax credit is generated on the date the facility is placed in service. Well, that's a significant value. And so when you're doing an IRR calculation, if you have big dollar amount transactions all happening within a short period of time, then the timing of when each one of those events happens can really have a very dramatic impact on the after tax IRR. And so if you're an analyst and you're saying, all right, well, what if the tax credit places in service in December or January? Well, you could move that investment tax credit by 1 month and actually get an astounding difference in the after tax IRR. And so that doesn't really make sense to a lot of users to think, okay, why is the financial return so different just based on a 1 month delay in placement in service? So to try to normalize, I'll call it normalize, or make better sense of the return metrics, investors oftentimes look at other return metrics. For example, after tax return on investment, okay, which looks at the sum of the benefits that the investor expects to get back, credits, depreciation benefits, cash flow, and call exit payment, right? The sum of those four gets them their total anticipated benefits. They divide that by the amount of cash that they invested in the deal, and that results in a return on investment or a total net profit. And then that tells them kind of what they're expected to make in a total profit. Other metrics, some people refer to the after tax ROI. Some people refer to that as a MOIC, which is multiple of invested capital. And then if that's not enough, some investors they'll net present value their benefits. Okay. And so and sometimes they'll use different discount rates for the various benefits. They might do a different discount rate for the credit versus the depreciation benefits and the cash flows. And so, we're used to working with investors to kind of evaluate the returns in the way that makes the most sense for them. And if they're still married to IRRs, sometimes we'll help them run MIRRs, or modified internal rates of return, or XIRRs. And these are all just an attempt to get more what they view as more rational sort of return metrics.
Thank you for that. And for the finance student who's listening to the podcast, who remembers from finance class that, rule number one, at least back in the day when I took a finance class, was you shouldn't make investment decisions based on IRR. You should make investment decisions if you looked at IRR and in net present value, you should make investment decisions based on net present value versus internal rate of return. And I won't go into all the reasons why internal rates of returns were viewed as a sort of a flawed comparative methodology. But I feel like within the low-closing tax credit community, since you're looking at the same type of product, you can look at a 15-year, 10-year stream, 15 years in the transaction, and it's apples to apples to apples. The IRR can provide a fairly accurate and comparative measure. But when you're working in other areas where your inflows and outflows are more episodic or more spiky or more, or in close proximity to each other, IRR can be particularly distortive.
So more to that, just what I'm seeing the most right now, especially with the emergence of this T-flip structure, is investors are evaluating the tax credit itself on like a price per credit basis. And so if they're going to transfer the credit, it's okay, how much am I going to pay for that credit? 90 cents, 95 cents, somewhere in that range for kind of like, typical, call it solar transactions in the marketplace. Okay. So the credits are sort of price per credit. The cash flow benefits are NPV'd using some discount rate, call it, I'll just say 8 to 10%. Okay. Not an uncommon range. And then the depreciation benefits using a different discount rate, using something more like 10 to 12%. And that's because of the perceived uncertainty around when exactly those depreciation benefits will be recognized, which explains the higher discount rate.
Yeah.
Okay.
So we're talking about this financial model, and a financial model that gets run, you then can calculate these NPVs, IRRs, and the rest, adjusted rates of return, modified rates of return. But you don't just run one model. You want to run different versions. Maybe you can talk a bit about, running multiple versions for both, an investor exiting with an option or a put versus staying in for the ultimate disposition of the asset. Maybe talk a bit about in a T-flip structure, to what extent you're running a model where they don't transfer the credit versus do transfer the credit.
Sure. Yeah. So a pure play tax equity investor, they're oftentimes looking at I'm going to talk in the context of ITC deals. And so that pure play tax equity investor is oftentimes looking at the shorter term investor benefit schedule. So call that like a 5 or 6 year investor benefit schedule, because they're thinking or hoping that there'll be some sort of exit option at the end of the 5-year tax credit period, and that the investor and the sponsor will, negotiate a nice, easy sort of unwind. Okay. Now their tax attorney is probably looking at the long-term benefit schedule, okay, to help support certain tax analysis, okay, to make sure that the tax attorney feels like the investor has a real strong argument that they're a real partner in the partnership, okay? And then the investor, even though the investor really is focusing more on that 5-year benefit schedule, they do look at the longer term benefit schedule because they do want to understand, hey, if I stay in the transaction for the long haul, am I economically better off? So they look at that as well. Plus, they look at that long term benefit schedule to help them understand what's a fair price they should be paid if they exit the transaction at the end of year 5. And so those are some reasons why they look at the long term schedule versus the short term. The sponsor is definitely looking at the scenario that involves it's the long term, it's the full 35 to 40-year economic useful life of the deal, but assuming the investor's bought out in year 6.
Right.
Okay, so that's the version of the model that the sponsor prefers to look at, because that's what they think is the most likely to happen. And so they need to know, all right, for the first 5 years, I have to share a certain amount of benefits with my investor. Then I'm planning on buying them out, and then I'm going to get 100% of the benefits on a go forward.
And then the sponsor developer also wants to know what their benefits are depending upon what the investor does or doesn't do, and there's early exit or staying in the transaction. How about with the T-flip structure? If the going in, the expectation is the investor is going to claim the credits,
Right.
Optionality to transfer the credit. Do you end up running a model where you also project a sale of the credits and the implications of that?
Yeah. So right now we've got various template models at the firm, and the template we're using the most right now has a toggle in it where you can select, are you transferring or not, which is fantastic. And you can indicate the price you're going to sell the credits. If your plan is to sell the credits, you can tell the model, assume it's transfer and assume the following price per credit.
Which then adjusts.
Investor is like saying to us, share both versions.
Right.
I'm sorry, what's that again, Mike?
I was going to say, and then it adjusts, toggles for the price, and then it has to toggle to adjust the capital contributions the investor makes.
Absolutely. And so the investor, if they keep the credits, their return, goes up, right? Because they're getting to use 100% of the credits. Whereas if the partnership sells the credits and then the investor gets a distribution of tax transfer proceeds, well, if you're selling the credit for less than $1, well, then the value you're getting back is also less than $1. So you can quickly see how, all other things being equal, if you opt to keep the credits, not sell them, then the investor's return is going to go up.
Right. I guess I would just modify that by saying the benefit in isolation of the tax credit versus the cash from the sale. Looking at those two pieces, the value is less, but there's other derivative effects of one or the other, which, I myself can look at models and tease out all those other derivative effects, but I can't do a good job of describing it right now on the podcast. But I would just note that, as you know, that there are these derivative effects, and, it's not as simple as you just get that difference.
Right.
Not the least of which is timing. Anyways, I I had to catch myself when I go down, starting to
Yeah.
wonder about all the different interactions that happen.
Right. I tried to preface it by saying all other things being equal, knowing that
They're not.
it never happens that way. So, yeah.
Thank you for that, Tony. So we've discussed, important investor benefits. We've talked about the different structures that are gaining popularity, most notably the flip structure, even creating a new structure, the T-flip. There's obviously a lot of other considerations we don't have time to discuss in depth today, but are there one or two other considerations that you wanted to at least mention to our listeners, and maybe we'll explore in a future episode?
Yeah, sure. So these are sort of like off tax. We're sort of deviating from tax now a bit and talking about accounting treatment. And so there are a few hot topics in the marketplace right now. Obviously, proportional amortization as a way to simplify accounting for tax equity investors, compared to using the dreaded hypothetical liquidation of book value method, is an important topic. And then gap accounting for transferred tax credits. That is getting a lot of attention right now. Seems simple on the surface, but obviously nothing is. Devil's in the details. But please, if reach out to us, because year end is fast upon us, and projects that if you're selling the credits, your gap accounting treatment, there's some issues there at the partnership level, and then to the parties that invest in these transactions up above. And that's a very emerging area. The accounting guidance is new, and so there's a lot to sort of decipher and go through there. So we'd love to hear from you to talk about the gap accounting impacts as well.
No, that definitely, when you look at the investment structure choices, the accounting, the gap accounting, how they report it, generally accepted accounting principles, how the publicly traded companies that are major investors, how they account for that is a consideration in terms of structures, as well as in terms of the consideration when they're negotiating with the sponsor developer as to what benefits they want, whether or not they want to sell the credit, not sell the credit, how much cash flow they want to be including, what the return rates could be, and the rest. All of that plays in to this gap accounting question, which is one of the reasons why, we at Novogradac helped lead an effort to allow this proportional amortization accounting apply more broadly among tax credit investments to, in some level, take out the gap accounting aspects of structure selection, because it, to the extent that the gap accounting is biasing different types of structures, it shouldn't be that way. It should be sort of the opposite. Investors be looking at what's economically best, and then the gap accounting should just be capturing that in a more appropriate way. But I'll stand down a bit from my soapbox. And we have done prior podcasts on proportional amortization and hypothetical liquidation of book value methods, and as they relate to energy credits, and we'll include a link to that in today's show notes. Thank you, Tony. We covered a lot of ground today, and we set up some possible topics for future episodes as part of our series here. Do you want to make any last minute observations?
I'll say this is a plug for our next year's renewable energy conference in DC. So the event we just had, as you noted earlier, sold out. And the next fall, we have a bigger space. And so we can accommodate more folks. And so we're looking forward to next year's event being even bigger and more successful. And so it's in the same neighborhood right across the street from the Park Hyatt. It's at the Fairmont Hotel in DC. So I encourage everybody to sign up, register as early as they can, but at least to know that the event is expected to be even bigger and more fun next year than it was this year. So,
and to follow up on that, I'd encourage both for the May conference in San Diego, as well as the fall conference in DC. We're in the process of getting the registration uploaded on our website, but if you send an email to cpas@novoco.com, you can get on the waiting list. So we'll get you registered once the online registration is available. So Tony, stick around, please, for our off mic section, where, as you know, I get to ask you some fun off topic questions to give you an opportunity to share some words of wisdom with me and for our audience. And to our audience, please do take a moment today to subscribe to Tax Credit Tuesday. If you're not already a subscriber, just go to your favorite podcast platform or platforms and subscribe. That way you'll be sure that you won't miss an episode. And also, so when you're traveling and want to listen to the episode, it'll automatically be on your phone. And as I say every week, if there are ideas or suggestions for future episodes, I do encourage you to send an email to cpas@novogradac.com. And we'll also give you a shout out when we do the episode to give you credit for spurring the idea. So now we've reached our off mic section. Okay, Tony, I always enjoy asking my guests various questions. And you're a recurring enough guest that I have to kind of a little bit further afield to keep from asking you the same question, even though some of the questions I can ask more than once because there's multiple possible recommendations you give me. But for today, I have two questions. The first is one I like to think about in terms of what we've learned in the course of our lives. So if you could travel back in time and you're going to give some advice to your past self, what age would you travel back to? And what advice would you give yourself?
Great question. So I know the answer right off the top of my head. It goes back to when I was actually in college, but it's got sort of broader, the lesson learned has sort of broader lifelong benefits and it deals with like facing your fears, basically. Anyway, when I went to college, I had the choice of, living in the dorms or living off campus my freshman year. And I made the decision to live off campus. And mainly because I had some sort of like fears of living in the dorms. It was an environment that I was just very uncomfortable with and something I was very intimidated by. And so I took a sort of like a safer approach and lived in an off-campus apartment. And, I've always regretted that because it meant trying to establish relationships with peers ended up being way more difficult than it really needed to be. And so the lesson I learned there was just, trying to, ways that you evaluate sort of intimidating environments or fears and that sort of thing and dealing with them in a way that gets you the most benefit. So I've always regretted not doing that because I ended up having to work so much harder to sort of establish those friend groups and peers in college. So it's learning that lesson has helped me throughout my life and personal relationships, plus in work relationships. Going to conferences, meeting coworkers or meeting clients, and all those types of things. It can be intimidating, but you really want to sort of rally yourself to overcome those fears to get the benefits of those relationships.
I love that. It reminds me of a posting that I put on LinkedIn and Facebook periodically, where I show the badges from conferences I've attended to, and I've attended a variety of conferences over my career, and I would keep most of the badges and just hang them up on the wall, and it's become quite a display of badges. And the point of that is to say that so much of life is just showing up. And going to our conferences is showing up and being around people. As you mentioned, if you went to the dorm, you'd be showing up in the dorm and be around other people. And as a consequence, meet more people. And, now with remote work and the rest, there's definitely a huge benefit to sort of being in the office, at least periodically in the course of a week. So you can just see other people and you don't know what is going to happen. But at the end of the day, you'll have met people you wouldn't have otherwise have met and things will happen. And you put yourself in an environment for things to happen. And that's why our conferences are so popular, particularly with so much remote work. It gives you a chance to sort of be in person and whatever you don't expect to happen can happen. And a lot of that can be good. And it's really nothing more than showing and just being in the room to see what happens. So thank you for that.
Exactly.
So my second question is seasonal in nature. It is that time of year when many of us will be gathering with family and friends for holiday get-togethers. We just had Thanksgiving and, the holidays around December will be here in no time. Is there a particular party game that you'd want to recommend to me or our listeners?
Oh, I'll recommend this to you and everybody else. So my kids, okay, this is it's a little goofy, okay, but it serves as a good icebreaker. And my kids love We Dance Party. And we turn it into a little bit of a competition. So,
Interesting.
it definitely gets you out of your comfort zone a little bit. So, and it's not your traditional kind of board game, but it's
Okay.
fun, gets people
Okay.
laughing, right?
That sounds
Um,
great.
yeah.
When I was thinking of this question, I don't know if I would recommend it to others, but it's definitely one that I've done before at parties, which I thought was it was an interesting kind of icebreaker. And I don't know if you've done it before, but there'd be a list of people of note, famous people, what have you, and it would be on your back. And you would go around to various people and you're trying to figure out who you are.
I love
and then asking them questions. And then of course, you find out who they are and they're asking you questions to try to, play like 20 questions and figure out who they are. And it definitely can be a fun way to have something to go up to someone and have an icebreaker, if you will.
I love it. I'm hosting our office holiday party at my house, which I started doing last year. And I love your suggestion. And I'm thinking I might use that as an icebreaker at the holiday party this year. So I appreciate that.
Okay. And I think, Tony, if you do that, you should be Mike Novogradac and I'll be Tony Grappone.
I don't want my team to hear this podcast before the party happens. I'll know who tuned into the podcast.
There you go. That'll be the test in and of itself.
Exactly.
Okay.
I love that.
Great. Thanks, Tony.
Thank you.
Thanks for listening. Thanks to all of our listeners. Have a great holiday season. I'll be back next week.
This weekly podcast has been brought to you by Novogradac & Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac & Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.